This is question number 22 of the midterm exam. Um, Intertech Corporation needed financing to build a new manufacturing plant. On June 30th of this year, Intertech issued $2,175,000 of 8-year bonds with a 6% coupon rate. Payments are due on December 31st and June 30th. The effective interest rate was 8%. What amount in interest expense did Intertech record for the June 30 payment in the next year? So apparently this bond is a semi-annual bond, and the current date is June 30th. The question is asking for the interest expense of June 30th of next year. So in terms of the number of payments, this is the second payment, right? Coupon payment um, date that the question is referring to. And given the effective interest rate is higher than the coupon rate, we know that this must be a discount bond. So first job is to input everything into the worksheet. So face value is $2,175,000 as provided, and the coupon rate is 6%, 6% right here, and payment frequency is 2, and maturity is 8 years, right? All these are provided. I just put the numbers into my worksheet, and the YTM, which is the effective interest rate, was 8%, so that's 8%. So the first task is to figure out the price, right? We can use the PV function, or we can use the price function. But if you use the price function, we need to set the settlement date and the maturity date. Here it's not directly, yeah, actually it's given the date but not the year, right? Then we have to assume any arbitrary number for the years that can still work out the same solution. But here I'm just trying to use the PV function to get the price of the bond. So if you open the equals PV and open the function, you can see the different arguments here, right? The first argument is the rate. And the rate here actually is not the coupon rate. It's actually referring to the discount rate, which is the effective interest rate, or the YTM here. But then we need to pay attention to the frequency of the coupon payment, because the interest rate here is actually based on the periodic interest rate, based on the frequency of the coupon payment. So in this case, it should be referring to the semi-annual YTM, which means that we should use this number, 8% divided by the frequency of the coupon payment. So that's my interest rate, or YTM. And NPER is the number of coupon payments. So we can calculate this by multiplying the number of years and by the frequency here. And the third argument is the payment. So this is the coupon payment. But the rule in Excel for this function is that we need to put the negative sign for the payment and later on the future value in order to get a positive price, or the present value. So this payment will be equal to the face value multiplied by the coupon rate, right? Because coupon rate is quoted in terms of the face value. But then don't forget, we need to get the semi-annual coupon payment. So far this is the annual coupon payment. So after that, we need to divide by the frequency of the coupon payment. And finally, we also have to put this face value similar to the payment. I added a negative sign in front of this amount, and this is the face value, right? So and then we can close this function, and Excel will give us the bond price. But the question is asking for the second interest expense, right? So, but with this bond price calculated, now I can prepare for the so-called amortization schedule, right? For the discount bond. We know that as time goes by, firm ultimately will pay this final face value to the lenders, or to the bondholders. But right now, the firm is only recording $1,921,563 into this bond payable. So let me just first put this into my bond payable. And so we know that there's a discount, right? So that's why this is called a discount bond. So the discount is basically the face value minus this bond payable, right? So that's basically my discount. So that's the current level of the discount balance. But as time goes by, we know that ultimately the firm will pay this much, not the current price. So as the rule for accounting, right, we smooth this process. Basically, how do we do that? First, we figure out the interest expense. So this one number period number here referring to the first or the second and the third, which number of the coupon payment. So this one is the date that the first payment will be made. So since the current date is June 30th, so that means it's going to be December 31st. That's what the number one here is referring to. So the first interest expense will be based on the bond payable, which is the current price, right? And then multiplied by the YTM. But then so far, this is the annual coupon payment. But this is what we are trying to do for the interest expense is the semi-annual coupon payment. So after that, I need to divide this by number two, right? The frequency. So that's the interest expense, but that's actually not what the firm is paying. What the firm is paying is for the cash interest expense, right? This is the interest expense calculated so far is what will be recorded on the income statement as the interest expense. But the cash interest paid will be based on the face value multiplied by the annual coupon rate and then divided by the frequency, right? Here I'm fixing all these numbers because this won't change when I extend this calculation for the first payment period to the other payment periods, right? So that's why I want to fix this amount, and this will give me the cash interest expense. So you see that what's recorded on the income statement will be higher than what the firm is actually paying out. So this means we will have a discount amortization, which will be the difference between these two, right? So that's going to be, it's like extra, that amount that will be recorded on the income statement. And then with this extra amount recorded, the discount balance will also shrink, right? Shrink by this. So it's going to be this amount minus the discount amortization. And also the bond payable. Let's say this will be this. So the bond payable will also be what? Will be the face value minus the new discount balance, right? But here I want to fix the face value because later on I want to drag the sale to the other time periods in order to automatically calculate this amount. Even though maybe for this question I don't need this amount, but just as a general practice, I think this is a just let's see, where did I so oh yeah, so the question is for the first number actually I forgot also uh, to fix this YTM, right? I don't want this to change. And also I forgot to fix this payment frequency. So, and this one is, yeah. So now I think I believe I can now extend this to the other years. And you can see all this can be automatically calculated. And if you continue to do that, you can actually get all this future balance, all these future numbers for these items here. But for this question, what I need is this number, which I highlight here in yellow, right? This is the interest expense for the second payment, which would be on the June 30th, right? So based on that number, you can see this 77,327. So it's going to be E here. So now let me check my answer. And I think I got this right.